So welcome viewers to the MG Academy, Mackay Goodwin podcast for business debt and insolvency insights. If you're an accountant, lawyer or other type of professional eager to receive some CPD points, feel free to look in the description to secure the CPD certificate, and some summarised show notes will be below. In today's episodes, we'll discuss director penalty notices, or DPNs as they're called, common scenarios and how to deal with them. And today, guys, we're lucky enough to be graced with the presence of the OG, the Godfather, Grahame Ward.
Thank you very much,
one of Australia's leading liquidators. Given your experience and I guess status within the industry, we'd like to pick your brains on what your thoughts are. So it's rather, I guess it's more of an informal thing from the heart. It's authentic and genuine, as opposed to like, we see so many other people out there with scripted kind of things. So, mate, I guess in your own terms, what is a director penalty? What is a DPN? What does it stand for? And what is it actually from the tax office?
Well, a DPN stands for a director's penalty notice. It's a notice issued by the ATO to directors where their companies have owed an amount of tax for GST, PAYG, superannuation, and have not complied with the timeline of making payment or lodgements. Making the payment of the tax debt has been on the company. It's not been compliant, and the ATO is making that a personal liability of the director to force compliance and to receive a payment.
So I guess what it is as well is it's the ATO escalating their collection process, right? They're like, Mr. Director, you've had this tax debt, or the company's had this tax debt, and you're not complying with the requirements, you're not lodging on time. There's no interaction, right? I feel that's when a lot of DPNs get issued out, when they're not interacting, they're kind of just pretending it's not there, head in the sand. So the tax office is like, right, bang, we're going to give you a DPN. I've got a question for you. So is it a situation with a DPN where people, they receive, so you're giving 21 days notice that you're going to be made personally liable, or is it a situation where they've actually made you personally liable and you got 21 days, you got a small window, 21 days to remit that penalty? What's the situation with that?
Well, there's two types of DPNs. There's one which is a notice, 21 days, where you've not complied as a company, but you have a timeline to comply, or you've received a director's penalty notice which has already made you personally liable already, and you are in fact only being notified to make that payment as a personal liability. Yeah,
so you're talking about the two different types there, right? Even if you've got 21 days to remit it, within 21 days, you need to do one of the four things in 21 days.
That's correct.
So that's why people see them. They go, oh no, I've got a DPN, and it's showing up. I got it I got it a week ago, so 7 days ago, right? And they're like, but it's showing up on my personal tax portal.
Yes.
So it must have expired. I'm like, no, it hasn't expired. They've hit you with that. So from day dot, they issue the DPN, they apply it to your personal tax portal, right? But it gets removed if you do one of the four things on the DPN within the 21 days.
Correct.
If you don't do something within those 21 days, it stays there. Now, you touched on there briefly about a lockdown DPN and a non-lockdown DPN, right? Do you want to give us a bit of background on what they are, the differences?
Well, the main one is the lockdown, which is where there hasn't been compliance for over 3 months or non-payment. There's outstanding lodgements, there's been a lack of communication, or just a general breakdown of communications between the company and the ATO. And the ATO has been forced to a position where the notice is then escalated to being a lockdown, an automatic lockdown off the DAC of the dates of lodgement. So, in fact, it's a direct personal liability of the director, and nothing can be done about that outside of the four options under the notice. And so, if that's brought back into order, then that expires, that particular DPN. It doesn't mean that there's not going to be additional DPNs and further compliance issues by the company impacting on the director personally with further notices, which can happen until such time as there's full compliance and full payment up to date in accordance with the terms of the ATO's notices.
Yeah.
So the lockdown DPNs can be quite, if you like, onerous on a director if they're not responded to, and the notice is based on the date of the notice, not the date of receipt.
Mate, it's confusing.
Yeah.
Right? DPNs are confusing. And not only that, and whether we're right or wrong, right? I think I've put out a couple of posts on LinkedIn, and by all means, guys, have a look at them. And I think I examined a DPN, and on the front page it says, you got to do one of these 4 things within 21 days of this notice. So that's the front page. That's what the cover letter. And then the notice itself says within 21 days after. So people are in like limbo. Okay, I've just received it. I've just opened it. Am I in? Am I out? What's the go? And I guess for me, I would say day 1 is the day of the notice. You don't want to risk that.
No, the response time is the lag and difficulty of directors responding to it.
Yeah.
And if that's not dealt with quickly,
Yeah.
you're in that last week potentially where there is very limited options available. The 4 options are still there, but the window is closing quite quickly.
Yeah, it
is. By the time they respond to it and or they seek advice, which is of course what we support, there is a very small window of time for it to be dealt with. And we get that a lot where directors simply sit on it for a week, or they're too busy working their businesses to be focused on it, or to go back to their original guidance from be it another director or seeking the comments from their family.
Yeah.
By the time they go through that process, a week's gone, another week's processed, and before you know it, you're in that last week, and you've got to do something, otherwise you become personally liable.
I think if anything that people take out of this ramble between you and I is that you get a DPN, you move quickly, and the time is ticking. Time is of the essence. So if you can take anything away from this, it is seek advice, and seek advice quickly, whether it be you and I or through another IP or what have you.
Professional advice, correct?
Absolutely. I've had accountants who actually don't know what they are themselves approached me and said, we didn't know what it was, so we just put it on well,
there's a lot of notices from the ATO, and amongst all the other outstanding mail and, if you like, creditor correspondence that some directors may get in trading a business, it gets lost in the forest. And they don't really appreciate what it really reflects as. It's not just another reminder notice to make a payment. It's making you personally liable. It's a big difference compared with a trade creditor doing a follow-up about an outstanding debt. It's enormously different.
So G-Dubs, as I like to call you, because you're a dear friend of mine, mate, people are like, well, I got a DPN, but it doesn't apply because they sent it to my wrong address. What's your response to that?
Well, it's normally sent to the registered office, and the registered office is, per the corporate records,
I think it's also sent to their
tax agent.
No, their personal address as well.
Okay. Well,
so what I'm getting at with this is they haven't updated it.
That's it. It's the obligation of the company and its director to make sure that the contact information at the ATO is correct. And the old trick of saying I didn't receive the notice because it went to the old address doesn't cut it.
Yeah, I had one the other day. The guy's like, "Yeah, I got a DPN, but I'm going to fight it because I sent it to my old address." I said, "Okay, so did you update? Did you tell the tax office that you changed your address?"
Yeah.
No. What? So they're mind readers, mate. You got no chance. Like, you are the director of the company. You have obligations. You have, and it's no good just to say, "I'd expect my accountant to do that," because it's not on them.
That excuse has been not able to be used for a while. Otherwise, everybody would be outdating their contact information. A great tactic to delay receipt of a DPN is to have an old address. So that's been exhausted. You need to have the correct address.
So, okay, let's focus on the 21-day DPN for now, right? And I'll give you a scenario that comes up quite often. Someone has received a DPN and they've entered into a payment arrangement. And as far as they're aware, the payment arrangement has remitted their personal liability with respect to the 21-day DPN, right? Is entering into a payment arrangement one of the 4 things that will remit the penalty?
No, it's not. You've got to comply with the payment of a debt. You've got to appoint an administrator. You've got to appoint a small business restructurer.
Yep.
And these are the options.
That's right.
And you've not done that.
So
there's something in the interim. It's not going to remit or remove that liability.
That's right.
Until such time.
So that is an expired DPN, right?
It's an expired DPN, and
so
it may well be in a payment plan, which ultimately could.
But they can no longer meet that payment arrangement.
That's right. They failed on the payment arrangement. So in effect, there is no compliance, and they're still liable for the balance.
So what you're telling me is basically that DPN is expired. Entering into a payment arrangement is not one of the 4 options to remit their personal liability. So now not only does the company can no longer actually meet that payment arrangement, the director's also got himself a personal liability. So he may as well just chuck that onto his asset and liability position.
That's it, personal liability, and I believe it impacts on their personal refunds of tax as well. It's a complete offset.
Yeah.
So it's wasted money in some respects in that they've spent time paying down a debt, but ultimately they're still liable.
Well, I mean, they've paid some people, some of their advisors, good money to enter into this payment arrangement, right?
Correct.
And they weren't told that the payment arrangement will extinguish, remit, cancel that DPN, right?
No.
So they're like, well, why wasn't I told that? The DPN sets out 4 things. You went for another option. You didn't want to do one of those 4 things within that period of time. So it's now your personal liability. So okay, so let's just say in that situation it does go into liquidation, or it does enter into an SBR, and okay, let's run with a liquidation. So the scenario is director's got DPN, director entered into a payment arrangement within the 21 days, didn't remit the personal liability, company now goes into liquidation. There is no return, so there's insufficient assets realised during the liquidation to warrant a return to unsecured creditors. What now happens to the liability, the director's liability? What's going to happen? The tax office is going to say what?
Well, it's going to progress a claim against the director personally.
That's right.
And start steps for enforcement. And if there's any personal income position, the director, which results in a refund, then that would be offset against their debt.
Yeah, and can the tax office, can they look to make the person bankrupt?
Of course. I mean, that's the ultimate step if they were to progress that. It is another option for directors, if they were going down that route, to consider personal bankruptcy and or some other arrangement in a personal insolvency.
And so how long does the DPN last for? Like, is there a statute of limitations?
It's indefinite as far as I'm aware, and there's no,
as far as I'm aware, it is
likelihood of it being removed until such time as a director either deals with a bankruptcy or some other personal arrangement which would compromise that debt.
Well, I had a scenario where someone had a DPN, they could have appointed, they didn't. That person eventually passed away. And so does that then form part of his deceased estate? And my answer to that was, well, yeah, it's a personal liability, right? Like, he needs to pay that before anything else goes to his beneficiaries.
Well, tax positions have got to be cleared off, I would expect, probate.
Yeah.
So all that has to be sorted with their personal tax returns, and ultimately then the executor would be dealing with that. I don't profess to understand the probate process exactly, but I would expect the tax position would need to be cleared off before any assets are distributed to beneficiaries.
I also had a scenario, G-Dubs, where someone's like, I lodged late, I put in a liquidation, but I haven't heard anything from the tax office. And then 5-6 years later, they call up whinging and screaming saying, I got this DPN, whatever.
That's right. Yep.
They refer to it as. What is that? It relates to the company. The company was liquidated. So why am I now getting this?
It's a personal director's notice. It's got nothing to do with the company being liquidated in the first place. The fact is the notice was not complied with.
And so I guess that's what I'm getting at. This not only was the DPN not issued at the time, what has happened in these scenarios is that, I don't know, perhaps this guy's starting to generate a lot of cash, I don't know, then the tax office had a look and said, well, you, mister, You over there, you had a company went into liquidation 5 years ago. We go through your tax lodgements, and we see that tax debt, let's say it's $500,000, $250,000 of that relates to BAS statements that were lodged outside of the requirements for the lockdown DPN.
Yes.
So outside, let's just say it's POIG and GST, yeah? So those BAS statements were lodged in excess of 3 months of their due date. So $250,000 of the 500 was late of that company that went into liquidation 5 years ago. We didn't raise the DPN then, but guess what? We're raising it now, and we're applying it to your account.
Yes, much later. Yes, it can happen.
It can happen, right?
Multiple DPNs. Multiple DPNs can be issued. You'd have a DPN which caused the liquidation to be brought on, and then later on, because of non-lodgements and lack of attention to what was effectively the ultimate tax debt, means that the ATO can issue a further DPN, which directors misleadingly believe that they don't need to comply with because the company is in liquidation. However, it's a separate DPN. It's a separate notice. It needs to be processed and dealt with. A lot of directors don't respond to it because they believe they've dealt with the liquidation.
Well, is that the liquidator's fault? I mean, again, I've had another scenario like that, right? And they've gone and said, oh, it went into liquidation and, that should have been, the liability should have been sunk with the company. Yeah. And I'm like, it should have, the stuff that was lodged on time. Yeah. But, mate, when I say to you, when I ask you a question, I said, what's your lodgement history like? And you're saying everything's lodged on time. The tax office then lodge a claim in the liquidation, provide a proof of debt. They don't break it down, said, here's $500,000 and here's all the amounts that was lodged on time and lodged late. We don't know. Correct. Right? We just get their proof of debt. So if you tell us, for example, that everything's lodged on time, we get the thing from the tax office that matches up. It's not for us to do a forensic review of what the director's personal liability position is. That's his own issue.
Yes, correct.
So don't, whilst we try and be as helpful as possible, it's not an issue for the liquidator.
We try to convey to the directors in a liquidation what is the outstanding lodgements on a claim from the ATO, so that they are aware of what outstanding lodgements may well be still sitting there and a future liability via DPN that can arise many months or a period after the liquidation is concluded. We're not funded to do a liquidation lodgement process. We're not in a position, unless the company has assets, to meet a lodgement process.
You know what? I feel in some ways, I think the ATO need to be a little more vocal as well, right? And why I say that is because often, people can be recalcitrant. I get that. In the sense that they can lodge but they don't want to lodge, or they just refuse to lodge, whatever. But some people I speak to, I come back and I go, like, mate, why was your lodgement, why were you always so late? Why were you regularly, repetitively late? And an answer to that is, well, I don't have the money to pay. I said, well, that doesn't mean you still can't report. The whole idea, and what the tax office want to get across is interaction. And even if you can't pay it, lodge it on time so we know where everyone's at. If you try and duck away from it, that's when you're going to get the attention and you're going to create the personal liability. So I feel there needs to be more communication out there to accountants and to directors and other advisors from the tax office to say, guys, lodge your stuff. Yes. We want you to lodge so we can work with you.
Correct.
And if you don't do that, then you're potentially up for, well, you definitely are up for director penalties. So they sit there, they don't register, they don't go through their records, so they don't see a liability on their portal. So how can one make informed business decisions, right, if their documents aren't up to date, their lodgements aren't up to date? They actually don't know what their asset and liability position is, because they haven't addressed their BASs. Correct. They haven't made their lodgements. And then they find themselves in this big hole. All of a sudden, we've got to do something. They lodge. It should be a couple $100,000. But
it's multiples of that.
Well, what's the tax rate? They talk about loan sharks and second tier lenders and all this type of thing out there who are circling these type of businesses, charging 10%, 11%. Tax office is charging 12% plus penalties.
General interest charge, correct.
So they're using the ATO as a bank and they don't actually realise that they're getting charged more than anyone else.
Correct.
I think that also needs to be, communicated.
Well, the ATO is obviously charging an interest rate because of the compromise, the fact that there's not being paid.
Agreed.
And it's on the directors to make sure that the compliance is there. If it was a low interest rate, there'd be a lack of compliance even more because of the fact that it would be considered to be commercially justified in not having to make the payment.
I agree, mate.
It has to be onerously charged as interest to encourage compliance.
Well, I think, mate, also too, if the ATO are out there saying, okay, guess what, guys? If you don't lodge, you're getting penalties,
yes,
right? And you're personally liable for your debt. And two, just to let you know, guys, we're charging almost 12% plus interest. I think you'll find people starting to comply a lot more.
Correct. It's an onerous interest to drive compliance. It's a false economy in some respects that people believe they can allow for that. But if they'd only paid for the professional advice in the first place, the interest and charges would be actually more than the cost of actually compliance.
Can I ask you something? Everyone has a different opinion, right? Some people don't have certain preferences, but if you're put yourself in the shoes of a director and you just receive a DPN, based on what you know, what is the first thing that you'd probably consider out of your options?
Seeking advice from a professional advisor and getting a view about the timeline and making a point of a milestone to move towards. So it needs to be a planned out response and considered based on what your financial capacity is in the company and really moving on that rather than just putting it to the side or considering that you can communicate directly with the ATO and believing that you can come up with an arrangement in your own right.
I agree.
I believe that once you receive a DPN, you really should be seeking professional advice, and most advice can be sought without any real cost. It's quite an obligation-free process to get and seek advice in the first place. And that should be the first option, to get the advice from a DPN notice.
Sure. So I guess for me, knowing what I know, the first thing, I get a DPN in the mail, my first option is, and I love what you said, but knowing what I know, my first option is straight off the bat, can I do an SBR? And the reason why is that, for me, SBR or everything else over the other options is, okay, pay the debt in full. Well, that's not an option because I would have already paid it if I could,
winning the lotto,
right?
That's an option.
Yeah, exactly right. Yeah, winning the lotto. So SBR, and the reason why I say SBR is, one, it's cheaper, it's less intrusive, there's less risk on the practitioners as well. It gives you time, and it generally results in a better return for everyone. And when I say that, the reason why I say that, because I'm seeing SBR proposals for 30 cents in the dollar for unsecureds, 20 to 30. I'm very rarely seeing that in Dockers and VA deeds, right?
Yes.
And that's because there's a lot of liquidator fees and trade-on fees and stuff like that that exhaust whatever the limited resource pool is. So, and I think I touched on this with Catherine Hines, our queen of SBRs previously. Even though you qualify for an SBR, you might not be able, it might not be your best option, right? Because your compliance might be crap. You haven't got any changes, or you're purely the ATO is the largest creditor in 90% of SBR matters. So basically, let's face it, in an SBR, it's the total value of creditors, not number and value. There's no casting vote from a VA or a voluntary administrator. Whilst you meet the requirements to do an SBR, you heavily depend on the ATO accepting the proposal. If you feel that the ATO is not going to be on board with your proposal, what's your next option?
If you consider the major creditor, which is normally the ATO, is not going to be supportive of a proposal under the SBR criteria of voting, the largest creditor has that vote. There is no alternative, which is in voluntary administration, the use of additional creditors and numbers and value. It's very technical, but there is more options in a voluntary administration for the proposal to be considered by the greater group of creditors and having their input on a vote for a proposal to be accepted, including employees and other unsecured creditors, for an example.
That's right. And so I guess I should have maybe said in that is you've got a situation where the tax office isn't too happy and unlikely to vote in favour, but you've got a heap of other related parties and some of the employees as well, for their super redundancy and stuff like that. They may be supportive, and therefore, you might opt for a VA because you've got more of a chance of getting the proposal over the line, and you're not just coming down to the ATO's interest; it's everyone's interest.
Well, you want everyone to be supportive of a proposal, and really it comes down to voluntary administrations generally being larger type appointments where you're dealing with a larger group of creditors. Small business restructuring and SBRs have generally been associated with only a handful of creditors, including the ATO. But when you're dealing with a larger appointment in voluntary administration, where you're dealing with criteria which exceeds the criteria of a small business restructuring plan, then you're dealing with a lot more stakeholders, and they should have more influence on how a proposal is considered and accepted. So that's for me how you consider the criteria.
Yeah, well, let's say for example you've got all these other kind of related parties for $500,000, and then you got the tax. Let's say you've got 4 related parties for $500,000, and then you got the tax office in there for 120. The compliance has been crap. There's been no changes. You can't afford to get a new accountant, something along those lines. I'd probably recommend a VA in those circumstances because you would want those related parties' voices to be heard. They've poured in a hell of a lot of money to keep it alive.
Related parties cannot vote on a small business restructuring plan. They are not able to retain the debt in a company was subject to a small business restructuring plan. They have to waive effectively their interest in any controlled recovery of their own personal position, which may have been used to supplement and assist the company in the past, working capital contributions or lens of personal positions. All that is wiped in a small business restructuring plan, where that can be still retained in the voluntary administration and utilised for influencing future recovery and repayment. They don't get that in a small business restructuring plan.
And sometimes people sit
Big
there
difference.
and say, the tax office, it's a commercial decision. They're going to get 15 cents on the dollar as opposed to a big duck egg, a zero in a liquidation. Why would they not accept it? And for me as a taxpayer, I'd say 100%. Like I want the money to come in, right? I'd opt for that.
Yes.
But obviously the tax office don't always just think on a commercial sense, right?
It depends on who you're dealing with. The ATO, it's really not known as to which allocated person is going to be dealing with that particular proposal or company arrangement. It really comes down to what the proposal looks like. Commercially, at the end of the day, the ATO, if it's the largest creditor, either has a thumb up or a thumb down position, and it can be quite brutal, notwithstanding the circumstances of other creditors, be it employees, be it other unsecured suppliers, others that continue to work in the economy that are not government related.
And so you don't need to comment on this, but I'll say this. I think it's also really important that it's conveyed to the tax office about the implications of potentially the business. What happens? Not only will staff lose their jobs, and not be able to pay their mortgages, and it's a tough market in some areas and industries at the moment. But also too, let's say for example, there's a shop in rural Australia that services a very small town, and there's a lot of elderly residents, and they're dependent on this shop, and the tax office doesn't like their compliance, doesn't like where they're going to be, but they're genuinely apologetic, or there were some circumstances there that forced them to do a restructure. I feel that it's on the practitioner to really ram that home, the not just the financial aspects, but I don't know, what do you refer to that type of
social
stuff?
Impact.
Social and political impact.
Social impact, and the culture and basically the fabric of the local community could be a major influence over and above. That's something that's not normally...
Doris's electric scooter ain't going to make it 40 k's to the next store to get milk. Yeah?
Yes.
And then what's she going to do?
Yeah.
And it all comes down to the tax office not liking a particular director.
It can be quite a...
How's that right?
Black and white position, looking only at one criteria being the return and compliance. They are only two components of what could be many factors on what should be an acceptable proposal.
So I feel that it's on the practitioner. It's not just a matter of, right, get your proposal, chuck 20 cents and see how you go. You really need to dig deep. It's much more than just the commercial outcome. It's social and political things as well, aspects that really need to be communicated in your reports.
It is ironic that the ATO could vote down a proposal whereby a lot of people lose their livelihoods and employment. Those parties also pay tax indirectly. If they voted it down, then they would lose all of that as being a consequence of their decision that they didn't receive a direct impact of a return from a proposal.
Yeah, and that's
the indirect
exactly
return
right.
is massive because
it's
you've got all
good,
those
right?
employees, the multiple effect of employment, all those things, social impact, all those things have an impact on what should be considered. But 100%. It's hard to know whether or not the ATO does do that all the time.
Yeah, but what I'm getting at is that it's not just the commercial return. It's not just that the ATO feel that the director hasn't changed and won't change. It's about what's the greater good for everyone. And that's what I think we have an obligation as practitioners, well,
certainly can
you
be
do.
More supportive and indicates a more universal position on a proposal of restructuring. Restructuring small business impacts on other small businesses. So if you've got a survivable business, then that enables other businesses that rely on that original one to survive. Every business that fails has a butterfly effect on others.
Yeah, and look, I've also... Another reason why I like the old SBR is because, and I know it's a touchy subject with FEG, because everyone's, FEG. FEG is sitting there, they tend to get involved in voluntary administrations.
Does anyone know who FEG is?
So the Fair Entitlement Scheme, right? So it's basically when a company goes into liquidation, and if a company is not able to actually pay their liability, their employee entitlements, there's a government scheme called the Fair Entitlements something regime.
Fair Entitlements Guarantee.
Thank you, Grahame Ward, GW #1, love it. Who step in and pay their entitlements up to a capped amount, which is a fair chunk of money, and it's great we have it. Regrettably, it doesn't cover super, but it covers most of the other ones. And so FEG have an interest in VAs in particular, because if the VA doesn't get up, or if a proposal's not accepted and it results in job losses, then the government's going to have to pay out, right? And so straight away, the practitioner comes under some form of scrutiny in terms of their forecasts and why they decided to trade. So it's a tough gig for a practitioner to make that decision, right? And so with an SBR, I find that it takes away that added pressure, right? The debtor remains in control. The practitioner doesn't come under scrutiny for deciding to trade. And, everyone's a winner when it gets up and everyone wins. So an SBR takes away that pressure and also alleviates the decision. It gives the practitioners not having to make a decision, not just on future profits trading in a VA, but also too having that scrutiny from the other parties. Debtor stays in possession, they continue to trade, the director's in control, and we're able to actually focus a lot more on putting forward a plan that works, rather than having to worry about outside noise.
Well, overall, you still need to have a cash flow positive business trading. So you've got you can't just leave it to the director. There's got to have some belief and a positive view that there is going to be a positive cash flow and capacity for a company to get.
Yeah, but hang on.
It's not on the practitioner, but it's certainly on the director.
You're spot on, but also too, it's a time where there's a moratorium. People can't enforce.
Yeah,
they trade their business, and they actually have time to think about how they're going to change So even if their cash flow is no good now, and even if they're not making profit now yet, they're going to put forward a plan where they're going to make some changes and use this process, use this platform to make a forecast for profits.
Yeah. If there's a positive outcome at the end,
yeah, but it's got to make sense.
It's got to be working capital supportive to get to the end.
Yeah.
There's got to be enough resources to enable that, with initiatives to change business practices to enable a more improved financial position.
Well, let's quote a dear friend of ours, Mr. David Hurst. Your proposal needs to be RSA, reasonable, sustainable, and achievable, right? So it may not work now. If you restructure your debt, you're no longer paying 12% interest on the ATO's debt. So straight off the bat, you're going to be reporting on time. You're not going to be subject to that stuff. You're going to increase your revenue by, who knows, a bit of marketing. You may have got rid of some staff or made some people redundant. You might be reducing your fees. But there's going to be a plan going forward which makes sense, which shows there's going to be a profit.
Yep.
And out of that profit, you're able to make contributions to pay cents in the dollar for the pre-appointment debt.
That's it. The ultimate outcome is estimated, and as long as the business can support the interim steps where you have a bad month or someone doesn't make profit, that doesn't mean it's all disposed of. It just means that it's got to be accommodated with respect to the stakeholders supporting it.
Yeah.
And so if that can be estimated as best as reasonably as possible and that there is ultimately a better return, then that should be supported. It's not to say that every business immediately becomes profitable straight away under the plan. It may be a process where it's still making losses in the short term and then progressively improves itself to a point where it does get more stable and supportive by the end of the plan.
Yeah, so look,
it takes time to turn the ship. Yeah.
I guess one question as well is that, and the final question is, in a VA, if there's a deed, or in an SBR where there's a proposal, the practitioner is required to provide a recommendation, right?
Correct.
And again, it comes down to whether it's likely to result, I guess, in a better return in one of the other than a liquidation, right? But what if the practitioner doesn't recommend it? Does that mean that creditors can't vote on it? Can the proposal still get up?
Well, there has to be a recommendation provided. It's up to the creditors to determine whether or not that recommendation is followed.
Yeah.
By and large, the recommendations are followed.
But it's a free country, right?
It is a free country.
Just because the professional doesn't recommend it doesn't mean that a plan can't be proposed or accepted.
Right. I've not seen a proposal not being accepted where it's been... if it's not been recommended, then I've never seen a proposal being accepted in a SBR. In a voluntary administration, I've seen creditors override the recommendation of an administrator.
Yeah.
In cases where there's been further information sought or some clarity on the proposal, ultimately it's a decision for the creditors to commercially view from their point of view as to whether or not something's acceptable or not. Okay. There's always risks with proposals, and if they can accommodate that, notwithstanding what the recommendation is, it's their decision to either vote for it or vote against it.
Okay, and so just one other thing. In a VA, the report goes out, the proposal's attached. Can that be changed after the report has been sent?
Yes, it can. It can be amended. There can be an adjournment of the meeting.
Yep.
There can be further clarity made, an improvement made to the proposal. That's in a voluntary administration process, as compared to a small business restructuring plan where that proposal, once it is signed, then that is it. Yeah. There's no adjustments. The legislation doesn't enable any amendment to that proposal once it's issued. So it's stuck in stone until such time as it's either voted for or voted against. If new information comes out or there's additional creditors, then that has an impact on the proposal. It may well dilute the return totally under a proposal. Yeah. So that is a big difference against voluntary administrations, in that there is some flexibility on the proposal being reflective of more information or some changes or some feedback from the creditors that may have not been considered at the time or been available at the time the report was issued in the first place.
So in essence, VAs, right, the ATO votes, related parties, if there are any, they can vote. It doesn't necessarily come down to the ATO's vote. It can come down its number and value. SBRs is purely based on the total value of creditors, which 90% of the time is the tax office has the majority in claim.
In most cases.
A proposal in a VA can be changed at any point up until, I guess, the major meeting of creditors, where an SBR it cannot. And even if a proposal is put forward in any scenario, regardless of a recommendation, creditors aren't forced to vote in any one particular way. They vote in accordance with what they believe is in their best interest.
Correct. Yes.
Grahame Ward, I love your work. Keep on being you, mate. Sorry, I hope you've enjoyed that chat. If there's any questions, whack them down. If there's anything you want to discuss, whack them through. So, guys, if you're an accountant, lawyer, or other type of professional eager to receive some CPD points, feel free to look in the description to secure the CPD certificate. And some summarised show notes will be below. And we'll catch you next time. Cheers.